And I'm going to say again, because some folks just joined this portion on the YouTube video. So if you want to follow these videos, get notification when there's new videos, hit the subscribe button and the like button, and you'll be notified when they come out. So today we're talking about taxation of Social Security. So this is another embedded future tax increase for most people collecting Social Security, or many people collecting Social Security. So some people, just still don't know that your Social Security can be subject to tax, which is amazing to me. But if you're not planning and you are just going into retirement, maybe you're 50 some years old and this is just not on your radar. I'm sorry, I'm pulling up my tax chart here. Then you're not aware of it yet. Just like the out-of-pocket costs in Medicare. It depends on where you live in the country. Your average healthy person pays about $5,000 to $6,000 a year in out-of-pocket costs after they begin receiving Medicare benefits. And so for a couple, that's anywhere from $11,000 to $12,000 a year or more. That's for a healthy individual. Most people who aren't close to Medicare age or aren't already collecting those benefits or receiving those benefits, that's not on their radar either. And so a lot of people are surprised when they hear that their Social Security can be taxed. All right, I need to pull up give me 1 second. Okay. I just need to pull up my tax chart for you. All righty. So let's talk about provisional income. So what is provisional income? So provisional income is a separate, it's not income that is derived from, people ask, well, is it modified adjusted gross income or adjusted gross income or, anything like that? No, it's its own calculation, provisional income. Provisional income is the income that the IRS tracks to determine how much of your Social Security is taxed. So it's an entirely separate things. It's not capital gains. Again, it's not Maggie. It's not AGI. It's none of that. It's its own calculation. So let's talk about what counts as provisional income. So again, the direct connection to your Social Security, anything that you earn. So any earned income, any W-2 income, any 1099 income, anything that you earn counts as provisional income. Well, that makes sense. Any distribution from your traditional retirement accounts, your 401ks, your IRAs, your 403bs, anything that is a traditional promise to pay the tax later retirement account. And yes, that includes RMDs. So RMDs, even though you're required to take those distributions, the IRS says you must take these distributions, but you have to pay tax on them, and it counts as provisional income. Any 1099s from that taxable bucket. So, remember your buckets. You have your taxable bucket, your tax deferred bucket, and your tax-free bucket, or tax advantage, whatever you want to call that last bucket. So any dividends that you get in that taxable bucket, you get a 1099 for. Any long-term capital gains, you get a 1099 for. Any short-term capital gains, you get a 1099 for. Any 1099s you get out of that taxable bucket, or K1s for that matter, you get out of that taxable bucket count as provisional income. And those short-term gains and long-term gains, sometimes you can't control because they're in mutual funds. Many investments are in mutual funds, and those funds have internal gains and losses all year round because they're selling and buying things. And you can't control that. You get your capital gains statement at the end of the year. And sometimes, you can have a down year in your fund and still get a large capital gain. So 1099s from the taxable bucket. Any pension income you receive. So if you have a pension, that's great. Any income you receive counts as provisional income. Any rental income, if you have rental properties, any rental income counts as provisional income. Interest from tax-free municipal bonds, that gets added in. So if you have, some people invest in municipal bonds with the idea of, hey, well, if I put enough money into tax-free municipal bonds, I can get thousands, sometimes hundreds of thousands of dollars a year in interest that I won't pay tax on. Well, the only problem with that is it causes your Social Security to be taxed because the provisional income calculation grabs interest from tax-free municipal bonds. And if all that isn't bad enough, they then add in 1/2 of your Social Security. So all earned income, distributions from your IRAs, retirement plans, of course, required minimum distributions, 1099s from the taxable bucket, pensions, rental income, interest from tax-free municipal bonds, and 1/2 of your Social Security. So how do we then calculate? We take all of that. Now, how do we calculate then how much of that provisional income equals taxation of your Social Security? Well, let's add these up. So I have the tables here. So let's first look at a married couple. And you have to remember that whether you're talking about the marginal tax rates or you're talking about things like provisional income, as soon as you're single, things get harder for you from a tax point of view, because you might have less Social Security because you lose your spouse's Social Security, or you lose yours and you pick up your spouse's, but you're likely to have the same amount of other income, because most arrangements are my spouse inherits my funds when I'm no longer here. So your tax rate jumps up because your tax margins decrease, right? Your income margins restrict because you're single filer, and that's the same with provisional income. So let's just focus on the married provisional income for right now. I see a question. I'll get to that in a second. So if all those things I just talked about, earned income, distributions from your retirement accounts, RMDs, 1099s from your taxable bucket, pensions, rental income, interest from municipal bonds, and 1/2 of your Social Security, if all of that is under $32,000, then none of your Social Security is subject to tax, zero. Anywhere from $32,000 to $44,000 up to 50% of your Social Security is subject to tax. It's a formula you have to complete to see how much of that money is subject to tax, but it's up to 50%. And then anything above $44,000, well, up to 85% of your Social Security is subject to tax. So you can see that with all those categories, including 1/2 of your Social Security, you can get above $44,000 from a married couple pretty easily. Now, for a single filer, of course, it's worse. So for single folks under $25,000, no tax on your Social Security, from $25,000 to $34,000 up to 50%, and above $34,000 up to 85%. So there are the tables. Now we're going to talk about the inflation of these tables, or lack of inflation of these tables, in a few moments, but that's, so we funnel all that information and we say, okay, where do we land? If you're above $44,000, as we are in the example I'm going to share with you, then you have to apply tax to 85% of your Social Security. So what does that look like? Let's talk about the tax applied. So stay with me here. I'm going to draw this out for you. I'm going to be looking down so I can draw this. So I went into a plan that we were just working on because I wanted to use actual numbers. Let me just see what the comment or question is before I move on. So Gerard asks, Gerard's stealing my thunder a little bit, but how are IRA to Roth conversions treated oh, I see, that makes sense. How are IRA to Roth conversions treated regarding provisional income? Well, it's a IRA to Roth IRA conversion is actually a distribution that's allowed to go into a Roth IRA. So it's considered a distribution. It's going to count as provisional income. Good question. So it's not uncommon for, if you're collecting Social Security and doing Roth conversions at the same time, it's not uncommon for your Social Security to be taxed at a higher level during that time. So of course, what you have to balance, you have to do the math, just like you do with your IRMA calculations. We're going to talk about IRMA in a few weeks, but you've got to make sure it's worth it. So the question is it worth it for me to pay tax on my Social Security for a period of time and maybe avoid that tax for the rest of my life, or lessen it to do these Roth conversions? But let's look at, and that has to be part of the planning process and to determine how much Roth conversions you want to do. And again, this is why you should work with somebody who understands the nuances of this. So I pulled this information from an existing plan. So the one spouse's Social Security is $40,248. The others is 37,644. So obviously they fall under this married couple, and they're all together. Their provisional income is over $44,000. You'll see here again how easily it reaches. So the math on that, those two, Social Security amounts to 77,892 divided by 2. So there's $38,000. So if we divide that by 2, that's 38,946. So it doesn't take much to get over that 44,000. So if we're not, and this couple actually has a pension and whatnot, so they're over to 44,000. So now we determine that this couple is subject to taxation. And now how much of that? So then we have to take, and again, just to keep it simple, we're going to do the full 85%. So we take 85% of the 77,892. It's not taxed at 85%. People often confuse. I've even heard people teaching this who say taxed at 85%. That's not true. It's 85% of your Social Security is then subject to tax. So then 85% of 77,892 is 66,208. I'm rounding up in this case. And let's assume they're in the 20% tax bracket. So this money here now has to go into that, marginal tax rates, right? That range from 10 to 37%. And then this 66,208 goes into here. And then we determine where it lands and what's the taxable rate. So this, let's assume a 20% effective tax rate. There's other income in there, and the Social Security either lands right on top of that, or is mixed in with it, however you want to look at it. But they end up with a 20% effective tax rate. So 20% on 66,208 is $13,241. So that's the tax that they have to pay on that Social Security. So there's a couple things that are frustrating about that. First of all, you receive this money and then you got to give back $13,000. But the other thing is, most people think of Social Security this way. Well, we're going to get $77,000 a year. They're counting on $6,941 a month, right? So they're saying, well, we need to live in retirement. We want to do this, this, and this. And we're counting on just call it $7,000 a month to live off of. I got that backwards. $6,491 a month. So we're counting on $6,500 a month to live off of. Well, not really, because what they may not have realized is that they have to pay the IRS this $13,241, or how much is that a month? I think it was, where did I go with that? We'll do the math real quick. Yeah, 1103. Yeah, so that's the difference for them. That's now 1103. And again, I'm rounding down on that one, that they're losing every month in their income just because of this tax. So it's not 6,941 that they get to live off of. It's $5,387, again, rounding down. So that can be a big difference. That's about $1,100 a month that they're giving up. That could be a vacation, that could be a car payment, that could just be, who knows, anything. So now what do people do to make up that $1,100 a month, or, $13,000 a year, however you want to look at it? Well, most people say, okay, well, I was planning on $77,000 a year or $6,500 a month. Now I need to make up that difference. And they say, okay, I'm going to take that out of my investments. And where do most people take it from? They take it from their IRA. So they say, all right, well, listen, I need to take another $1,100 a month out of my IRA. But if you take $1,100 a month, or $13,241 a year out of your IRA, what do you have to do? We have to pay tax on that distribution too. So we have to what's called gross up that distribution. So to to net out using a 20% tax rate, to net out $1,000 or $13,241 a year, which means what does net out mean? That means that's the amount that you get to spend. Well, you have to take out $16,551. $16,551 is what you have to take out, pay tax on, and then you get to spend $13,241. So it's a compounding problem. It's not just that you're giving up $13,000. It's likely that you're giving up $16,551, and you got to send that portion of the 3,300 and change to the IRS for additional tax. And now you're drawing out of your IRA. Maybe you weren't planning on drawing down on that IRA at that time. So if you're not planning for this and you hit it by surprise, boy, it can be really a detriment to a financial plan. And suddenly, if you're rolling into retirement and you've got these plans for vacation, and listen, folks, $13,000 a year, most people allocate $10,000, $15,000 a year for a vacation. So that could just wipe that right out. So it's important to know what your taxation of Social Security is going to do to your plan. Now it's not, obviously the answer, the issue isn't just the $16,551, because there's a couple of things that happen here. So we're talking about, we talked about taxes applied. We talked about the provisional income, the definition, and the charts. We talked about filling the gap. Remember, you got to take $16,551 to cover the $13,241 that you need to spend, because you have to pay tax on that difference, right? Taxes got to come out of there. How about the opportunity cost? Well, now, if you're doing this every year, let's just say, you earn 6% on that $16,551. Well, folks, that's hundreds of thousands of dollars over your lifetime. If you do the math, $16,551 by just 6%, say over 30 to 35 years, geez, folks, you're easily talking about $400,000 or $500,000 in lost opportunity cost there, because when you have to take this money out to spend, you don't get this. You don't get that return. Never to be seen again. If it's in there, it's invested. Even the market drops, it's likely the market will come back. You have an opportunity to gain the return back. But once you spend it and send the tax to the IRS, you never get a benefit on that. So hundreds of thousands of dollars if you have to take out that additional amount. And it's worse. Every year, Social Security goes up, right? Typically we get a modest increase. This year, they're talking about 10+% because it's an inflation factor. It's not directly tied to CPI, but CPI, Consumer Price Index, is part of the formula and calculation. So as the 77,000 grows because of inflation increases, more and more of your Social Security is going to be subject to tax, because this part hasn't changed in years, and it's not likely to. These haven't increased. Your marginal tax rates, they adjust every year, not the rates, but the income levels for the rates. We're gonna see an overhaul of the tax code, I'm sure, but this, I don't see a change in this. It's never really talked about. So it's likely for the next 10, 20 years, whatever, certainly probably the next 10, these rates here for provisional income are going to be exactly the same. And just think about it. If suddenly, because of inflation, 77,000 becomes, 88,000 and Social Security, and one half of your Social Security is tied to provisional income, well, you're at 44,000 right there. So you can see how it can really get out of control. So you've got to fill in the gap. You got the opportunity cost. You lose the opportunity to make money on that money that you're taking out of your retirement accounts or even other investment accounts to pay for your standard of living that you've given up because of the taxation of Social Security. And then we've spent a lot of time on timing. The timing of Social Security is something that people think about when they say, well, when should I take my Social Security? And there's books written about it and calculators out there and a lot of great data, but unfortunately not enough people are talking about the taxation and the effect. if you're unfortunately in a situation where you kind of have enough money for the rest of your life, you feel like you probably do, this could cause a drawdown 7 years, or actually, 7 to 9 years sooner than not having your Social Security taxed. So there can be a big effect for folks. They could be running out of money earlier. It's less money you can pass the heirs if that's a goal of yours, or just funds to have available if you need care or something in the future. So this is very important. Again, a lot of people focus on this timing. When should I collect Social Security? And that's important too. But this taxation of Social Security is just as important. Other considerations are, if you're doing, Gerard talked about, well, I was talking about Roth conversions. I guess somebody else talked about Roth conversions too. If you're doing Roth conversions and you start collecting your Social Security, it's going to affect your provisional income. You've got to set up, you got to see if there's a benefit to that. You have to do the math to see if it makes sense to do those Roth conversions while you're collecting Social Security. Some people like the idea of waiting until, they're done their Roth conversions, they're age 70, whatever their age is for them, and then collecting Social Security. Nobody really goes beyond 70, but it may make sense for you to wait. You could get more out of the Social Security Administration, and you're not paying tax on that Social Security while you're doing Roth conversions. However, some people feel that, well, wait a minute, if I'm doing Roth conversions and I'm collecting Social Security now, even though I have to send some back to the IRS, I'd rather use that amount of Social Security that I get after tax to help pay my tax on the Roth conversions. So some people like that cash flow to help pay that tax. And that's fine too, as long as it works out for you. So it is specific to you, of course, how you manage these taxation issues with your Social Security. If it makes sense for you, whether you just let it run and it is going to be what it's going to be, or you look for strategies to avoid the tax or reduce the tax on Social Security. So we heard about the provisional income. There are two things that do not cause tax on Social Security, and you'll not be surprised. Anything Roth, so distributions from Roth IRAs that are held more than 5 years, do not cause taxation of Social Security because there's zero tax. So anything Roth, your Roth IRAs, your Roth 401ks, no tax on Social Security, and some properly structured cash value of life insurance or life insurance retirement plans. There's no tax if they're structured correct. If you take money out of there for your retirement income, which many, many people do, they also don't contribute to taxation of Social Security. So it's something you have to pay attention to. It's something that should be part of your plan, but that's how it works, folks. I think we've covered all the items with taxation of Social Security. We've got a lot on the agenda for the next few weeks. We're going to go through some different financial planning topics, like I talked about income related monthly adjustment amounts. That's another big consideration for Roth conversions. So Gerard asked a good question. Should the standard deduction be factored in here? No, doesn't apply. Standard deduction doesn't apply. It's provisional income is the list of items I talked about. It's not modified adjusted gross income. It's not adjusted gross income. Standard deduction doesn't apply. It's its own calculation, just like capital gains tax is its own calculation. Good question, though. All right, folks, it is 10:51. I hope this was helpful. Again, if you want to subscribe, hit the subscribe button. If you want to schedule time with me, you can do that. There's some limited time on the calendar. It's been really busy for us. Knock on wood. Thank you. We appreciate all your support. We've had, several new clients this year. We have a bit of a waiting list. New clients are onboarding in September now, might even have to go to October, but we appreciate all the support. If you're a client and you need an appointment, reach out to us. Even if you can't find something on the calendar, we'll make time for you. We are back in the office 2 days a week for appointments. Otherwise, we're doing Zoom meetings, which are just so darn efficient, but I love seeing you all in person. So we'll see you not next week, but the following week. Hope you enjoy the rest of your week. Take care.